This is the industrial side. Most industrial businesses are either won or lost in the day-to-day operations. These are conversations with the operators who run these firms, talking about how they run them, what works, and what doesn't. Patrick Dichter, how you doing?
I'm doing great. It's good to see you, Brian. How are you?
See you. Yeah, got a big move ahead, so it's been a busy week, but I'm glad we were able to do this.
Nice. Yeah, moving always takes way more time than you think, and it's never quite over, So,
Yeah, and it makes me feel kind of like I'm not really doing the right things in the gym because I spend a lot of time working out, but after like 3 boxes, I want to rest. So I might have to adjust my programming a little bit.
gotta protect the back.
Yeah, I gotta lift with the knees. So yeah, today we've got a topic that I have to admit, every class I've had on accounting, I've dozed off or started to stare into space. As I've gotten more involved in actual businesses, I've realized how important it is. So I wanted to use today to get your expertise with what you're doing. You're the owner of Apple Tree Business Services. You do a lot of accounting work. To kind of talk this through, as for me, someone going into running a home services business and working and talking with other business owners within manufacturing distribution. But what do I need to know? I feel like looking at a lot of companies, particularly like manufacturing distribution, I'm paying a lot of attention to the P&L. I'm paying a lot of attention to what drives expenses, where the revenue drivers are, concentration. But the balance sheet, I feel like is like something I talked to a lot of business owners. They're just not really, they're just worried about what cash is in their bank. So
Yeah.
I kind of want to dive a little bit into that. Like in your mind, what do you think is more important, the P&L or the balance sheet?
Well, gosh, I don't think I could pick one or the other,
Yeah.
but they tell very different lessons, in terms of like what's happening in the business. And I would say, the fact you're looking at a balance sheet always good, and then people need to start to understand the balance sheet or, how those work together to really see the full picture. So we can talk about like, that journey or what matters. But then if I had to pick, if it's an inventory heavy business or it's manufacturing, you definitely need to look at the balance sheet. But if it's services, then maybe I'd pick P&L if I had to pick, one or the other.
When you're like onboarding, let's say like a light manufacturing client, like what's like the weirdest thing do you see? Like do you run into owners that basically don't have a balance sheet or like have no familiarity with it?
Yeah. Yeah. Or there's like just one kind of created at year end, or like
Yeah.
inventory's not really tracked, in the financials until year end. I would say even before that, the first iteration is the business owner that's kind of like, for lack of better terms, I'll call them checkbook Charlie.
Yeah.
Like they don't have financials. They're just going, how much is in the bank account? And like that dictates their decisions and their feelings, right? Today I have 15 grand, or I have 55,000, or I have no money in the bank account and I have to make payroll, So we see people even start there of like just checkbook Charlie, how much do I have? And then, they start to like understand gross profit and a P&L. And then you have some that start to understand, balance sheet. And then it, grows from there as you kind of learn these things.
That's good that you mentioned, especially like the inventory side. I mean, that's usually like the biggest asset, but sometimes it could be overstocked. Just like, but based on personality, like I don't, I'm scared of running into a situation where I don't have enough inventory when I need it. So let me like overinvest in inventory by 1 million. Or the same thing with cash. Like
Yeah.
I just want 5 million cash in the bank. Like it might have nothing to do with like what the business actually needs to operate or anything like that.
Right.
So like, is there like ratios that you think of, or is it like business to business? Like, how does a business owner know if they're making the right decision in terms of like their investment into the asset side of their balance sheet?
I'd say the first place I would start is, try to have like 2 to 3 months of savings. So if you have 2 to 3 months of cash that can cover your, your overhead or your monthly burn, that's a really good place to be, just to give you some breathing room and to make sure that you're doing okay. The next thing that I would really pay attention to as a ratio would be your gross profit margin, like in services, depends on the industry, but, you probably want to, try to hit, like a 30 to 50% gross profit margin. So what that means is, let's just take, fencing, for example. If you sell a $5,000 fence, if you're running at 50%, that would mean the parts that go into that fence for Mrs. Jones and the labor for that specific fence for Mrs. Jones are $2,500. So you're running at 25, 50% gross profit margin. So gross profit would be the first kind of KPI to pay attention to and to really keep your eye on, of like, where do we think we're pricing things at and where does it actually shake out? And then, then you could, there's different ratios like an acid test or like a, quick ratio that you can Google these, but they measure like how quickly you're able to meet accounts payable or like how liquid you are to, run the business. So it really depends on industry and also like your risk tolerance and like if you have debt or not and, how fast your customers tend to pay. I'd say really where it starts is like just get a baseline. Like let's start looking at our gross profit. What do we think it is? Like let's start looking at, our days of cash on hand and what do we think it is? The other would be draw a line on accounts receivable. Say, okay, right now we have, I don't know, 350,000 hanging out in accounts receivable. Let's try to make sure it never goes above that, right? So like even if we're growing, how do we try to really stay on top of our accounts receivable so that it doesn't just like balloon up over time? That's one that owners sleep on a lot.
When there's like a, let's say like 45-day terms or 60-day terms or 30-day terms, is it part of like the bookkeeping side that you do to like flag like these 15 customers are late, like go reach out to them, or like what involvement do you kind of have in that process? Because I think that's one that's a little tricky because like it's like especially you want to maintain the relationship. You don't want to seem like the landlord and be like rent's due, but at the same time you need the cash back in the business.
Yeah, I mean, when we send monthly financials, we'll generally give a couple comments on what we see going on. And so if we see AR start to grow and creep up, like we'll point that out to the client. With some of our clients, maybe 5 to 10%, we're doing their invoicing and
Mhm.
AR, but we're generally not chasing it down very hard. And I think that's where most business owners need to step up is like it gets uncomfortable, but yeah, pick up the phone, be the squeaky wheel, call the guy and say, "Hey Bob, like we've had this invoice sitting out there. It is past due. What can we do to get that taken care of?" And like I say this online a lot. Accounts receivable is a full contact sport. Like you have to stay on it, you got to hit it, you got to be diligent with it regularly. Otherwise, even if your clients like you and they want to pay, they're busy too. So it's just noise that they tend to forget. And so you have to really stay in front of them with like emails, texts, phone calls, and maybe it's going to the owner and the client has an admin that, could pay your bills faster. So you just really I- I've seen so many people that can totally transform their business just by paying a lot more attention to accounts receivable versus just emailing an invoice and like hoping it gets paid.
Yeah. 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 Like, I mean, like, for instance, if you're doing like commercial HVAC, you may have some big projects at some part of the season and then some not at the other side of the season. And like the payment's not coming immediately. So it
Yeah,
kind of could be the difference between being able to pay your bills or not, or being able to fund
totally.
your, but on the other end, like just what we just talked about with AR being a contact sport, like I've heard a lot that it could be like a benefit to you too, also to not pay your bills so fast to your folks. What, I
Yeah,
guess,
let's talk about that for a second.
yeah.
But the other thing I see, just back on AR
Yeah.
for a second, people don't get their invoices out on time, right? Like, oh, they finished that commercial HVAC job for that restaurant and they could have sent it today, the first of the month, and like they get around to it 10 days later. Well, you just added 10 days to yourself. And the further the time goes by, like the more people tend to like, just be slow with it. So that's on invoicing, get them
Yeah.
out fast. But on the bill pay, it is a mindset thing where I think a lot of new business owners, they're like, I'm a responsible adult. This is on my checklist. So I'm going to pay my bills as fast as I can. And you really have to be careful with that because if somebody gives you net 30 or net 45, you should take that. Unless like, back on the commercial HVAC example, if you have a sub that like you really love and you know that that money means a lot to that guy, paying him quick might protect a big relationship, right? But if you're buying parts from like a multi-billion dollar supplier,
I don't care.
take the net 45. Like they don't know who you are. So it's really some days it's as simple as like collect your cash as fast as you can and like slow your bills down and
Yeah.
slow down the outgoing.
Yeah. It's hard because like even what you mentioned before with like 3 to 6 months of expenses. I mean, like you could just treat your business like a personal like your personal finance lessons you learned your whole life. Always pay your bills like before you pay yourself or like
Yeah.
hoard your money, save. But the difference is when you have a paycheck from a job, it's a W-2 income every 2 weeks, every month. It's very consistent. The revenue for your business is really unpredictable, so
Yeah,
it doesn't necessarily translate the same way.
totally.
Yeah. Yeah. So like do you end up having to change the way business owners classify things when you start working with them? Such as like I've seen like just like current assets cash, inventory, like just like really nothing broken out. You have to end up reclassifying financials when you start working with a company.
Yeah, so our accounting firm, we work with people that are like as small as, 250K a year in revenue, as big as 20 million a year in revenue. I'd say that the majority are like probably like 1 to 10 million in revenue. So just to paint a picture of like how big they are, right? So for a lot of them, when they first come in, we're doing a big bookkeeping cleanup, and then we have like our recommended chart of accounts based on their industry and based on what we like to use. So a lot of times we do end up reclassifying stuff on the P&L and also like cleaning up the balance sheet a lot with, making sure there's a clear picture of like, fixed assets and loans and all those things.
Got it. Got it. And so do you end up seeing any like common like misconceptions about what things mean? Like whether it's the P&L or the balance sheet? I'm
Yeah.
thinking like is there because a lot of business owners they're experts in their area and they have an accounting guy. That's the accounting guy knows the accounting stuff.
Well,
But like what does a business owner need to know?
I'd say it really starts with misconception that QuickBooks does it for you.
Right.
So we'll see a lot of people come in that the owner did their own bookkeeping in air quotes, or like an admin person did it. And we like QuickBooks Online, but they do a good job of their marketing, making it seem like it's just like easy to DIY. And that leads to a lot of accounting errors. So what we'll see is there's no reconciliation done every single month, so your P&L is not accurate. Or we'll see, deposits aren't matched as they come in. So, your revenue is always going to be off. Another one we'll see is people, if they're invoicing out of QuickBooks Online, they'll send invoices and then some of those customers don't turn into jobs. They're almost using it like a proposal. Then your revenue is overstated, right? So if you are selling kitchen remodeling and you had two people that didn't turn into customers, you could have revenue overstated by like 200 grand with those invoices sitting out there. Another big one is CRM integrations. Like every CRM out there will slap on their marketing, will integrates with QuickBooks Online. You're not very careful with how you do that and you know how to do that properly, you'll create a big mess. Like I've seen a company that does pond management, like cleaning ponds monthly,
Yeah.
messed up their integration with Jobber or House Call Pro, one of those. And literally all the recurring revenue was overstated because the integration wasn't done properly. Or you'll just see customers get doubled up and revenue doubled up, or you'll see like inventory be a total mess with
Yeah.
those here. So really what you need to do is like split those out and map it properly by job so that you can see like how much are we actually making per job. And then yeah, another big one is like back to people not understanding the balance sheet. There's just not accurate like loans or equipment on the balance sheet, or like all the bank accounts that
Yeah.
exist, or they don't match the tax return to the financials at the start of the year. So like retained earnings, it's never accurate. So
Yeah. Yeah.
those are some of the big ones.
Do you recommend people never put anything personal on their business expenses?
Yeah, if you can, like it's great to always have that separation for two reasons. One, it really helps with accurate bookkeeping. But two, if you have a lot of commingling of expenses and you get audited, the IRS is like, okay, now everything is fair game. Like, if they see that type of commingling, then they're gonna audit everything,
Yeah.
and pierce the veil.
Yeah. Yeah. Another way it comes in is just through like if someone looks to transition out of the business, which a lot of baby boomers are in the process of doing, the buyer's going to look very closely at everything. Um, and it's a big thing that's been coming up, I think, over the last 5 or 6 years in terms of just different expectations of what cash flow itself looks like in a company from the owner to the buyer. Do you ever work with like buyers doing any diligence, or do you support any owners like in terms of cleaning up or auditing their books ahead of a sale?
Yes, and yes. So we work with a lot of people who are buying businesses, and we do the financial due diligence and the quality of earnings report. And then maybe 10% of the time we're representing the seller. So we're helping the seller get ready to go to market, or doing like a accounting cleanup before they go to sell.
What do you feel like the problems that you see are a lot of the times? Like things that owners are doing that you need to clean up for them to get the maximum value at sale?
I would say having no accountant or no bookkeeper, is an obvious mess. Another big one is a lot of commingling of personal expenses. For some of these guys that take cash, like they're taking a lot of cash and not reporting it or not paying taxes on that. So I'm not here to be the IRS, but if you tell a new person like, yeah, this business makes $700,000 a year profit, and then the tax return shows like 400K, and you're like, oh yeah, there's another 300K that we don't report. Well, you're just not going to be able to sell for that because they can't tie it down and the bank isn't going to give you credit for that, you know? What else should I say? What do people do to not be prepared? I would just say you have to mentally be prepared that it's a part-time job to sell a business. So like having all your ducks in a row, having all your information, you know, business brokers, there's some not so good ones and there's some really good ones that will, you know, save you a lot of time and save you a lot of money because it's a lot of back and forth with
Yeah.
potential buyers.
Yeah. Do you ever have to convert folks' offer from cash to accrual right before a sale?
Yes, not right before, hopefully, but yeah, that's a pretty common request. The buyer is looking for accrual financials and the seller doesn't have them at all.
What's the benefit of using cash accounting? Never really knew.
Man, that is a hot topic. I prefer cash accounting or like light accrual.
Why?
So what I mean by that is like let's have a picture of your accounts receivable, let's have a picture of AR, but like to me with these small businesses, like if I pay my, you know, commercial insurance policy once a year and then like accrue that throughout the rest of the year, I don't know. I think there's a balance there of like accruing everything or not. The accounting purist would say like full accrual financials give you a full picture of like what is your actual margin or when did you actually earn that revenue. But I just go back to like there's a balance of, you know, sometimes cash tells the truth because that's when you actually got paid and that's what your true cash conversion cycle is. So anyways, I like looking at it both ways, but I think sometimes like on Twitter or in the accounting world, like the purists are
Yeah.
like, oh, full accrual is the only way to go. And then if most small business owners that run a $3 or $4 million business understood like how much investment of money and time needs to go into it to have full accruals, then
Yeah.
opinions change.
And that goes to the question of like what kind of team does a business owner with like someone doing 2 million in revenue on commercial HVAC, like how much of an accounting team do they really need? Because if they go accrual, then you know, and especially if they want to go even further and do audits and things like that, if they want to be really tight belted about their financials because they want to build something to eventually sell, like what kind of team do you need at that size? Like just a bookkeeper enough? You need a controller too, or what would you suggest?
$2 million HVAC, I think, you know, you're fine with QuickBooks Online, a CRM, an outsourced bookkeeper, you know. So outsourced bookkeeping would cost you anywhere from like 500 to 1500 a month for outsourced bookkeeping. I don't think you need a full-time employee there at 2 million a year commercial HVAC.
At what point do you start to need that?
Depends on the industry, but I'd say probably like for a lot of people, it's between like 7 to 10 million
Mm.
when they think about like a full-time controller or a full-time staff accountant.
Yeah. Mhm. And then I guess like what kind of like do you need to find someone who's been in that specific industry before, or is it pretty transferable in terms of like basically you're doing like a founding account? I don't know if you could call it that, but you know you build you get some guys, get some trucks, you're running HVAC jobs. Now you need somebody smarter on the numbers. Like is there a particular expertise that someone would need to have to just like basically do the cleanup kind of stuff that you guys do when you take a client on?
I think it helps if you have industry experience. You know the nuances of, how customers get paid and how the invoicing works or what the chart of accounts should look like. A big one is understanding the CRM, you know, so making sure that the accounting team you work with understands that CRM, but it doesn't have to be industry specific in most of these, you know, like services, light manufacturing, distribution. I don't think it needs to be industry specific. If you get into really, you know, niche things like commercial GCs, like yeah, you need somebody that understands like full, you know, construction accounting and like job costing and all that.
Yeah, yeah. So it's kind of a spectrum, but no, that makes a lot of sense. I think for some people, they're just doing it themselves, or their wife is really good. She manages the budget at home. Why can't she manage the budget of the
Yeah.
business? So it's like it's hard to think that it's needed, but as you get bigger, like especially you get towards the size where you'd be interested for the PE acquirer or strategic acquirer, it could mean millions of dollars in difference.
Really? There's usually an event that triggers somebody upgrading their bookkeeping. Like if somebody started their business from scratch, here's what happens. They go to their bank and they try to buy a building, and the bank says, "Give me a balance sheet." And they go, "What's a balance sheet?" Or the bank can just tell it's not accurate, right? So
Yeah.
like they went for lending, didn't work. Or they join an industry peer group or like an
Yeah.
association, and the peer group is like, your bookkeeping's not good. Like you need to upgrade your bookkeeping. Or they have a bad tax surprise. Or they're thinking about selling. So they're like, I'll clean up my financials, you know. So those are usually like the things when the guys started it from scratch. Like triggers like, oh, I should upgrade my accounting now. It's a little different when you have like a searcher who's buying a business. They tend to have a higher appreciation for quality accounting.
Yeah, that makes sense. I guess kind of maybe my last one for you. Like, what do you think are areas that people get wrong in sort of like these product inventory heavy businesses in terms of how they're doing their accounting, whether it's how they're managing cash conversion, how they're getting inventory, or something else?
What do they get wrong?
Or what could they do better? I guess it doesn't have to be so negative, but
I think, this might sound a little like contradictory, but accounting and financials are a lagging indicator. So I think a lot of people underestimate just like even looking ahead, right? So just go back to this fencing business, for example.
Mhm.
Like if I want to grow a fencing business and take home more cash, you need leading indicators around like how many leads did we get? How much volume is in our pipeline? How much of a backlog do we have? What percent of our jobs do we get called back for, like punch list items? All of those things are upstream of like really profitable, plenty of work, consistent cash flow. So I'd say don't overlook the leading indicators
yeah,
before they hit your P&L. I think the other thing is gross margin is overlooked in every business. Like that is the lever that's most easily moved and will really have a major impact on the healthier business. Like again, back on the fencing thing, like if my average job is 5,000 and I can increase my average ticket to 7,000, and instead of making 2,500 per job, now I'm making like 4,000 per job. That just multiplies and adds up really fast versus like trying to see how I can squeeze and save like, $20 a month on my utility bill. So I'd say
yeah,
gross margin being overlooked is a big one. And the last would just be like sales fixes a lot. Like if you can grow and increase your sales volume, it can really fix a lot because there's cash coming in to feed growth and like, your overhead goes from being 20% to 12%. Like that goes a long way for a business.
yeah. Do you ever see gross profit margins just be too high? I see this a little bit with EBITDA margins, where I know that there's some sort of under investment from gross profit perspective. Like, I guess it would be maybe charging significantly higher than competitors or having really cheap input costs. It could be seen as an advantage, but sometimes it's, especially when a buyer's looking at it, try to understand like what are the things that I could do to add value.
I think
Can be
if,
compared. Yeah.
if a business is for sale and the gross profit seems too high, it probably means that the accounting is not right, right? Like they're not fully factoring in the materials or the labor they needed to go in there. Now, if it's on the bottom line, like if the bottom line just doesn't pass the sniff test, if it's like that HVAC business is 40%, it probably means they're just understaffed or it's not very transferable. You know what I mean? I see that a lot when accounting firms go up for sale. There's like 45% profit margin, and it's like, well, yeah, because Bob has been killing himself for the last 10 years and like
Yeah.
his team is underpaid and like, he works 80 hours a week. So if you buy Bob's firm, like you're probably not gonna be making 45% profit.
Yeah. Yeah. Does that come into play when you do like the exit planning stuff? Because I think that's the number one thing is typically there's not enough of a team. The owner's doing too much. It's not transferable. And I don't know that that is maybe within the scope of the accounting, but does that conversation come up in terms of like, yeah, like 40% margins on an accounting firm probably would never sell. Like someone probably has to tell the owner like, hey, are you doing everything? Then if you want to sell this, you need to build people up in the team to be able to do it. But like for the next 3 years before you'd be able to really transfer this to someone else.
Yeah, I'm trying to definitely do more and more of that with our clients and have those conversations with clients on like, what are your goals? Like, do you want to sell this thing in 5 years? And like, at least make sure they have a range of like what the business could sell for. And if they're very disappointed by that, then we can say, okay, well, here's the things that you can do to make it worth more, right? Like make it more profitable or have more of a management team built out. But unfortunately, like sometimes we just don't know until
Yeah, it's
they're
too
like,
late.
I've got an LY.
Yeah, hopefully they don't ask for any further financial details.
Yeah.
All right, Patrick, well, this is great. If people want to get in contact with you, what's a good way to reach out?
Yeah, thanks for having me. This is fun. You can find our firm's website, Appletree Business Services. The domain is appletreebusiness.com. You can connect with me on Twitter, LinkedIn, or wherever. Patrick, and then my last name is Dichter, Dichter.
All right. Thanks, Patrick. I'll put all
Thanks
that
for
in the
having
show
me.
notes. Talk to you later.